All right, this is part 2 of demystifying the loan process. We're going to talk about different loans, what they mean for you, who backs them up, and how easy it is to get them. I'm sitting here with Michele Brandt from Fairway Independent Mortgage, and I'm Eric Lundquist with MRG Realty Partners. How are we doing?
Great, how are you?
Excellent. All right, so tell me about these two pots of money.
Yeah, so I like to explain it in as easy terms as possible, and I'm really visual, so I like to use my hands a lot.
Yep.
If I punch you, I apologize.
I'm over here.
So really when you're looking at borrowing money, there's two big buckets to borrow from in lending. Conventional financing and government loans. And they each have pluses and minuses for sure. I'll talk first on the government loans because it seems like there's more misconception about them. So within the government sector, there's 3 loan options: FHA, VA, and USDA or rural development. Those are one and the same, rural development and USDA.
Okay.
FHA first requires a 3.5% down payment. There's no income restrictions and there's no geographical restrictions. So it's the most available to the public. Most people can get an FHA loan. The things that are really nice about the FHA loan is it's a low down payment. The other nice thing about FHA, I like to consider it, if you fit into the FHA box, meaning your score's 600 or higher, but barely, you get the same interest rate or a very similar interest rate to that of a 700 or an 800 credit score buyer. So as long as you fit into the FHA box with their criteria and guidelines, you pretty much get the best interest rate and the best mortgage insurance rate you can get. I'll back up and talk a little bit about mortgage insurance in just a minute, but know that FHA loans have a nice low down payment, they're really easy to get into, and they do carry some mortgage insurance as well. The VA loans are for veterans and their spouses. There are some small extenuating circumstances to other classes, but it's a very small group of people. So for the most part, it's veterans. A retired veteran certainly counts. Somebody that's in the reserves, they can get a veteran's loan, but that is a 0 down loan and that carries no mortgage insurance. Mortgage insurance is something that does nothing for you. It's insurance so people think it's awesome because everyone loves insurance, but it actually protects the lender. So that if you were to default on your mortgage payment, the mortgage lender files a claim with that entity, that whoever holds the mortgage insurance policy, to be made whole. Right. Something that buyers, though, they have to pay for that on the lender's behalf. So at the VA, there is no mortgage insurance, which is the biggest benefit by far for VA lenders. Meet that minimum credit score criteria, have your VA eligibility benefit, and you're off to the races. With VA loans...
What is that? So if with an FHA, and we're going to talk about conventional soon, but with those and you're paying that private mortgage insurance, what kind of dollar amount is that? What are we talking about?
For a $200,000 loan, it's roughly $150 a month.
Oh, that's significant.
It's substantial.
So you're in a VA loan, you don't have that $150 because you put 0 down. And the idea of it is the bank has to have enough equity, or whoever the whoever the lender is, they have to have enough equity to reduce their risk, right?
Right.
So without that equity, they have to pay that insurance because the process of having to go through and resell the home, that time and money, that's why they do it.
Yep, it's just an insurance policy for the lender. The FHA mortgage insurance does not ever go away. No matter what kind of equity, by buying down the mortgage, continuing to make their payments, it's permanent. Always in place.
Didn't know that.
This is the biggest negative with FHA mortgages, is that it's a permanent feature. You have to sell the house or you have to refinance it into a conventional loan to get rid of mortgage insurance. And VAs just don't have mortgage insurance, so it's awesome. Great
so
feature.
If you were to say a person puts 3.5% down on a $200,000 loan, about how many years does it take to get to that maybe 20% equity where they could roll in and refinance into a conventional loan?
Gosh, this market, it so varies. I mean, because there's 3 factors, right, that can reduce that mortgage insurance. And so conventional loans, you can get rid of that mortgage insurance.
Right.
Market appreciation, which we're in a market that's appreciating. Paying down your mortgage because you pay principal and interest every single month, and then improvements. If you do any improvements to the property, you buy a house with an unfinished basement, you finish the basement, you've got 20-30 grand in equity. So it can be as little as a year, 2 years.
Yeah,
It depends on your down payment as well. So there's no minimum time that you have to have for it to be removed on conventional loans.
Okay, good to know.
So that's VA. You also, a lot of folks think once you use your VA loan, you don't get to use it again.
Right.
You get to reuse that thing over and over and over again. You work off of what's called a certificate of eligibility, or COE, and your entitlement amount. And so there's a little calculation that we use to determine whether or not you can use that VA loan again and again. But you can even have more than one VA loan on your record at one time, as long as your entitlement's not used up. So
Got it.
cool.
So I could sell a home, move, and the closing the same day. I could close on one VA loan and open up a new one
You
the
got
same
it.
day.
I'm doing one right now.
Okay,
Yep.
great.
Yeah,
Good to
it's a
know.
really cool product. USDA, I'll
Yep.
touch on really quick, is rural. So you need to buy not in a rural like farm setting. You can buy it in a town, but it's a geographical region. So none of Anoka County, Hennepin, Ramsey, none of the major metropolitan areas count. The closest one to the Twin City proper would be, Monticello, Big Lake area, so up on the northwest side of town. There are geographical restrictions, and it's black and white, and there's a website you can get information to find out where that is. There's also income restrictions, so it's a lot more restrictive of a program, but as long as you qualify, the mortgage insurance is less than half of an FHA loan, and it's a zero down program. So it's amazing for buyers that qualify because the payment's lower, even though you've got no down payment.
So if you're in a higher income bracket, maybe
Forget
there's a
about
chance
it.
you won't. Got it.
Yeah, then we gotta go to FHA.
What about, like you say Monticello, let's say if it's outskirts of Monticello, but it's a development where there's a big builder who's
Totally fine.
nailing tracks?
Yep.
That could
The
be
house itself is fine. It
Okay.
doesn't matter. It's where it is on the map.
Got it,
Yeah.
cool. One thing I want to touch on while we're talking about the VA loan, if you're a vet or active duty, cop, firefighter, healthcare worker, or teacher, we have a program called the Uncommon Hero Project, where as a real estate agent, I give back 25% of my commission to you as a way of saying thank you. And what kind of things can you offer as a lender?
Yep. So for that program, we offer a free appraisal, which is up to $400 value.
Nice.
And there's nothing special. There's no strings attached to it. It's just what you get on both of our sides for doing what you do.
Yep.
There's no class you have to take. There's nothing you need to sign up for. It is just literally savings because of what you're doing.
Yep. And if
Or
you're a
get back.
buyer, it's pretty cool because if you work with an agent, it's generally free because the seller pays the commission. If you're a buyer, you actually get paid to work with us. So you get a paycheck kind of from me. I'm sharing my paycheck with you, and you're getting a free appraisal. So that's pretty cool.
It's really cool, deal.
Jumbo loans and non-conforming. Let's talk about those.
Yeah, so conventional loans, just stepping back, because the two buckets of money, we talked a lot about government. Conventional loans are pretty similar, but basically the difference between a conventional and a government, that PMI mortgage insurance, if you have less than 20% down, it's not permanent. So if you were to do, the minimum down is 3% actually, so it's a little lower. If you were to do 3% down, once you obtain that 20% equity, the mortgage insurance can drop off.
Yeah. And you're sending letters periodically, and you're kind of required to every year, like, hey, you can analyze your loan to see if you've paid it down,
You got it.
or
Yep.
have you done those improvements, or there's
Correct.
been appreciation of the value of your
Yep.
home, reevaluate.
And
you
then
can track that.
automatically, once your loan amount drops below 78%, it automatically drops
Oh, okay.
of the
Good to
original
know.
purchase price.
So if you're not paying attention to your mail, like
It
most
will
of us,
automatically
it'll
go away. It takes like 9 years or so on a 30-year loan. So you want to do it sooner if you can, but
Yeah.
and then with conventional, the higher the credit score, the better the terms. Government kind of, once you meet the minimum criteria, here's your rate, here's your mortgage insurance.
Yeah.
With conventional, 100% driven off of rates.
Gotcha.
So, or off of credit, excuse
Sure.
me. So if you've got a 680 credit score, your 3% down mortgage rate will be really high. And
Yeah.
by really high, I mean a half point higher than what it would be if you had a 720 credit score.
And a little bit technical, when you say point, what does that actually mean? Half point versus a point?
4 versus 4.5%. So 4.5% versus 5%, a half a point. That can mean a lot
Yep.
over the life of the loan, depending on how long you have it. So,
Got it.
not to deter people, and if my credit's not a 720, I shouldn't get a loan. Great government loans are great. I had a government loan. My very first one was an FHA loan.
Yeah.
So perfect go into getting my first mortgage.
It's a judgment call, but on FHA and VA loans, we can actually, when we're representing a buyer, we can ask the seller for some concessions where they offer back some of those closing costs. So literally, you're walking in with, nothing out of pocket.
Right?
Depending upon how competitive the market is, it doesn't
Yeah.
always get, if I get a conventional loan versus someone who's asking for seller concessions, I might not go with that.
Right.
But if it's the right thing to do, you can actually come in with very little down. So there's some limitations on those, and we won't get technical. That's something to talk to your realtor about.
Yeah.
So, okay, so going back up
Yeah.
forward, do we want to talk about jumbo? Or
We can talk about it a little. So jumbo basically is just a loan amount size. That's all jumbo means. So
Okay.
the conventional conforming limit is $453,100 in this metro area for
Okay.
Minnesota.
Okay.
It varies from state to state, so you
Okay.
definitely need to check on that. But in Minnesota, it's $453,100. So if you have a loan amount, not purchase price, loan amount higher than $453,100, it's a jumbo product.
Okay.
A jumbo product means you can't run it through that AUS system, automated underwriting system, to get your approval. It's all a manual underwriting that an underwriter has to review because it's riskier. It's higher loan amount. It's more money that we're borrowing. Generally speaking, it's a higher down payment. Your interest rate varies a lot if you have less than 20% down. Even 30% down gets you a lower interest rate. Where on the conventional loan, higher down payments don't always mean lower interest rates. So it's kind of just a different animal, not to deter or scare people. It's just a little more extensive process. Instead of maybe those automated underwriting system might just say we need the most recent tax return in W-2. Jumbo loan will almost always need a full 2 years, all schedules, all attachments. They almost want your DNA, not to deter, but just to let you know, it's just a little more in depth of a process. So, and the non-conforming loans would be things like a condo that doesn't meet the condo improvement criteria. We just had a buyer that bought into a condo development. It's a smaller set of units, and one of the rules is that you can't have one owner own more than 10% of the units.
Right.
And this one owner, it wasn't like he owned 100 units. He owned 4 out of 20, and that's more than 10%.
Yep.
And so that makes that condo ineligible for conventional conforming financing.
Okay.
So we go into a non-conforming or non-warrantable condo situation and get it approved that way.
Yep.
So
We're solutions driven, so we got to find our ways around.
it's just outside of the box thinking.
Yeah, just
And
gotta
I
figure it out.
love that stuff.
Yep. And what was helpful about that scenario was that the borrower had a significant down payment, right?
Correct, yeah. More down payment equals more opportunities, more options for
Got it.
different kinds of loans.
All right. Well, that is the different types of. Anything else to add?
I don't think so. I think that, that's the icing on the cake. There's certainly much more to talk about. And I don't generally talk about all of the loan programs to every buyer because it's overwhelming and confusing. So we go through the pre-approval process first to find out what. I'm not going to talk about a jumbo loan if they're buying a $150,000 house in Elk River. It's just not appropriate. It would scare them, and that's just not our goal. So, yeah.
So let's touch on this because we talked about this earlier. You're a loan broker, so you have access to all of these types of products. Can you explain that a little bit?
Sure. So you've got your banks, and then you've got your brokers or correspondent lenders is really what we're called. So we are Fairway Independent Mortgage, and that basically means we get to go out and they solicit us for business. So they want us to use their products. Here's a cool product we offer. Here's a cool program. And then we get to decide which one's best for our buyers.
Yeah.
So it's not like a large box retail bank where you're just, here's our guidelines. If you don't fit into them, tough luck, better luck next time. We will find, just like this condo gentleman that didn't know that he had this issue, we'll find that solution. So very, very seldom do I not have an option to find a buyer a solution.
That's awesome.
Yeah, it's
Cool.
fun.
Well, there you go. Catch us again for part 3 where we get into some technical stuff about loans.